the brains trust of the JPMorgan team, which is with us. Just to remind you, Kalpana Morparia, CEO, Bharat, Iyer, Head of Research, and Sajiid, Chenoy, the Chief Economist. Mrs. Morparia, you know, there is always this constant fear, and that fear keeps coming back, that the US rate hikes or the Ukraine issue or any other geopolitical, the Italian data that came in yesterday could bring the markets, crashing down would be a strong word, but definitely correcting steeply. Now, if there were rate hikes and if money turned away from emerging markets, would you worry about the rupee? Would you worry about the Indian markets? Or are you damn sure that they would be relative outperformers as they seem to be today?
I definitely feel so. And, you know, so there will be some events which might cause a temporary correction in the market. But just given the long-term momentum that this economy is now going to go through over the next 5 years, I do see a flow of money continuing. And remember, the domestic investors are not yet fully invested. So, you know, the point that I made earlier, that you're definitely going to see a floor coming in every time. If you look at, Bharat has these numbers much better than I do, but equity ownership amongst the domestic investor class is at an all-time low. You know, if that can very easily double from where it is now. And it's not as though the foreigners are going to stop investing in this thing just because interest rates have gone up by 0.25% or 0.5% in the US economy. Economists love to predict that doomsday scenario. But if you really look at the real economy, the underlying momentum of the returns that this economy can deliver, I'm very sure that money will come.
She's really taking you up on your bearish views you had. But Bharat, I want you to come in on the point that she made. You know, just trying to play the devil's advocate here. Every bull market sees a correction at some point in time. And some are predicting that if not a price correction, at least a time correction is what this market might see. What's the sense you're getting about what the extent of that could be?
See, I think, Sonia, we're already seeing that phase of consolidation. You know, if you see, the beta rally actually petered out almost within 1 week after the election results were announced. And if you see over the last 2 months, the headline indices have held their own and in fact have gone a little higher. But the underlying internals have actually improved significantly. What you've seen is a lot of highly leveraged beta companies correct by almost 30%. And the outperformers over the last 2 months have actually been the good old favorites, IT services and healthcare. So I think, you know, this correction, consolidation is happening as we speak. But, you know, it's a testimony to India's long-term fundamentals that the money is not leaving the market. It's staying within the market. It played the beta rally and now it's chasing quality.
Okay, as you pointed out yourself, the good old favorites IT, those stocks are in the news this morning after Cognizant went and cut their guidance. And you've liked that space quite a bit. Would you still hold on to your view, or do you think just for this year there is some caution that needs to be put forward?
No, we still like the IT services space. See, our positive stance on IT services has really been premised on two factors. One is a very solid improvement in the fundamentals of the US economy, and secondly, our expectations that the rupee is not going to appreciate very significantly, though it may not depreciate significantly. I think what has happened in the case of Cognizant, at least the house view, is that it's a lot of company-specific factors, which again are temporary. So, you know, we are really not changing our stance on IT services at this stage.
Okay. Mrs. Morparia, you were telling us that money came in 10 days, $1.5 billion for actually beleaguered balance sheets. How will the government's disinvestment program do?
So if you look at the government disinvestment program, I think there is appetite certainly for some of the sectors and they should do well. But in the oil and gas segment, there are a lot of policy uncertainties. You know, the path of roll-off of subsidies. Some of these issues really need to be addressed because there will be very big questions in the mind of the investors. But overall, in terms of the appetite of investors to pick that up, I don't see that as an issue at all. I want to make one other point in the context of what Bharat said on, you know, the money has continued to come into India. 1 or 2 days you'll see a negative. I think in August, first few weeks we've seen a negative. But otherwise, if you just look at the general trend over the last 2 months, it's been very, very positive. And India has a very uniquely diversified market. If you look at a lot of the other emerging markets, they tend to be dominated with financial services or oil and gas or metals and materials. India is very unique in the diversity that it provides across sectors. It's also very unique in the diversity that it provides across ownership of companies. So you have private sector, you have state-owned entities, and you have listed MNCs. Hardly any emerging market can talk about this breadth. So even when a particular sector goes out of, or you think it's run off too much, people have rotated into, some of the defensives now. And as you see some greenfield projects getting announced, some of the debottlenecking taking place on the core infrastructure, I see no reason why those will not come back into fancy again.
You spoke about the divestment conditioned upon, more reforms coming in. Actually, not much has been announced by the government. It was a run-of-the-mill budget. It could have looked like a UPA budget itself. It had nothing at all different, even in spirit, forget detail. Do you think that this bonhomie towards India will run off if the government doesn't quickly follow with something?
Lata, I'm going to pass this question on to Sajiid because he says it so much more eloquently than what I would. So, Sajiid, over to you.
Lata, I think the most fundamental point that, budget is a statement of account. Reform doesn't happen only in the budget. I think there will be 100 small steps. The most important part of the budget was this government believes in a continuation of fiscal orthodoxy. That you want to bring the fiscal deficit down from 4.1 to 3. It believes in the goods and services tax. It believes in the UID program. In all the noise, the biggest adjustment in India has been the fiscal deficit's gone from 6% in the center to now lower than 4.5% in the last 2-3 years. The oldest truism in economics is for growth to prosper, macro stability must sustain, and both on the fiscal deficit and the current account deficit and in core inflation, things have gotten much better. So let's give them a pass. I don't quibble, I don't worry about whether the number is going to be 4.1 or 4.3. That's less relevant. By February, if we've made some strides towards a goods and services tax, and if we've made some strides towards a roadmap to begin to gradually liberalize fuel subsidies and possibly fertilizer subsidies, that would be a giant step forward.
So as far as growth is concerned, Sajiid, I know the projections at this point in time for the next year, but do you think we could beat those projections on the upside purely because we're seeing a lot of things pick up on the ground, be it auto sales, be it the IIP data, etc.?
So the second quarter number, April to June, is actually tracking 5.8%. I'm not sure most people have realized that. It's being driven largely by a very big pickup in exports. So to the extent that the 5.8 is what the April to June quarter is being driven, IP growth has been very strong, driven by two factors, as you mentioned. One is exports. The other is consumer durables. Whether consumer durables sustains, was it because of the excise duty cut till June, or is it a more organic increase, we won't know till later. But what's indisputable is export growth has picked up very sharply. Now, to the extent that the second half global forecast for growth is stronger, India will benefit from that. So I think there are green shoots here that growth is going to pick up, at least for external purposes, to the extent that some things can be done at home to get some capex later in the year. That bodes well.
What's your GDP forecast for the full year?
Well, we're in the 5.5 range, but what will depend crucially is how agriculture plays out. So I think if the deficiency is less than 15% and agriculture doesn't degrow, and therefore rural demand does not get depressed, you could still touch 5.5, which frankly would be a very good launching pad for higher growth next year. You know what? If this economy grows too soon and grows on the demand side, we'll be back to the core inflation problem. So I think what you have to see is supply-led growth and gradual growth, so it's sustainable.
Yeah, of course. At least we're getting, 15.9% in electricity in the latest core sector number.
Exactly.
So maybe, let's hope what you're saying is right. But Bharat, now I want to pit you against the two of them. Yeah. The boss is talking about, the NPL problem being seriously overblown and good money coming in for beleaguered assets. Sajiid is talking about the macros very speedily getting corrected. But why is your choice of stocks all IT services and healthcare? Why is it not economy related, yaar? Look at this word. We had particularly cautioned against chasing beta in the financials and even avoiding companies with high leverage.
No, Lata, see, our stance right from the beginning of this year has been that, the election will throw up a decisive mandate and growth will pick up meaningfully. We've been saying play this through clean structures. So it's not that we do not like the economy-sensitive sectors. We like commercial vehicles. We like cement. We like metals. We've been super bullish on metals since August last year. And again, in the case of financials, all we have said is be a little more discerning. Because what's going to happen is the high-quality financials with a very strong liability franchise, they are likely to do very well in an environment like this. Because, they're going to have the money to lend out. Whereas the companies, which are largely dependent on wholesale funding or which do not have a great liability franchise, you will appreciate they're still going to struggle in this environment because no rate cuts, wholesale rates are probably going to stay elevated. How are they going to participate in this growth? So I think, the market from after having played the beta rally in the run-up to the elections, post that, it's going to turn a little discerning. because it's going to focus on where the alpha is. So I think that subtle shift is already happening, and as I said, over the last 2 months we've already seen that beta rally fade, and we've seen investors turn more discerning. And it's not just at the sectoral level. Even intra-sector, what we are seeing is that quality, or whether there are discernible signs of an improvement, those companies and stocks are doing much better than where we're not seeing an improvement. So I guess you're just going to have to be more discerning after the beta rally we've seen.
Discerning or more conservative?
He'll make very good bonus. Look at the sectors he mentioned, which did well in the first quarter earnings: cement, metals, high quality financials, IT, healthcare. Those were his sectors. I think he's made his bonus.
And all of you are extremely conservative, by the way, Sajiid, even Bharat. So I'm going to ask you about what's the the FII stance at this point in time in terms of portfolio allocation, because for the first part of the year it was the beta trade that worked the best in the market, whether it was banks, infrastructure, etc. Has that trade played out, or do you see it come back into fashion in the second half?
See, Sonia, I think it's actually, we put out a note today this morning on how investor positioning has changed over the last quarter. And 2 points to be made out there really. First and foremost, FIIs are meaningfully overweight India in the context of emerging markets. So India has a weight of roughly 7%, and the FII weight is almost 10%. So there's a lot of enthusiasm for India. That said, I don't think we've seen a very serious churn in terms of sectoral allocation. I mean, if you go back even 6 months back, the FII favorites were financials, consumer discretionary, telecom. That very much continues. And surprisingly, in the high beta sectors, they're still meaningfully underweight IT, underweight metals, underweight energy. Perhaps the one sector where we've seen a meaningful change in portfolio allocation is in industrials. So I guess, as I said earlier, the enthusiasm for India is very much there, and that will sustain. But, as Kalpana mentioned earlier, what investors are waiting for is discernible signs of a turnaround in some of the more beleaguered sectors and stocks. And I guess, as you see green shoots of that, perhaps there is scope for that shift.
All right. So what to look forward to from the markets, from the economy? That question to all of you in a minute after this break.